Hello and welcome back to another video. Now, if you're a business owner and at the end of every month, you're looking at your bank account and wondering, where the hell did all the money go? It's not because your marketing isn't working or that you need to cut expenses from somewhere. It's because you have never actually done the math to figure out exactly how much money your company is bringing home after every sale. It's because you have never actually done the math to actually figure out if your company has what it takes to actually scale. And that's the problem. Because here's what nobody tells you. Most business owners do not do any sort of financial modeling. And I'm gonna guess that the agencies and the marketers that you've hired probably haven't either, which means that you're both just guessing. You're throwing money into ads, into new hires, into software, and you're completely guessing, right? You're throwing money at things randomly, hoping that you're gonna finally be able to scale. But if you understand one number, and I mean just one number, you'll know exactly how much you can spend on marketing, rent, new hires, and still keep your profit margins incredibly fat at the end of every year. And the number that I'm talking about is gross profit margin. So in this video, I'm gonna break down how to calculate that number and how to increase your gross profit margin, because the thing that I see most businesses struggling with is they don't have clarity on this, and so they never actually get to the point where they know for a fact that the math makes sense to start to scale. And it's gotten to the point where a lot of clients that I talk to are actually bleeding out and they don't even know it. By the way, I'm qualified to talk about this because my name is Hunter Larson and all I do every single day is run an advertising agency, or in 2025, we helped generate $10.9 million for our clients. Because the one thing that we do that I consistently see most agencies not doing is calculating and financial modeling to make sure the math makes sense when scaling. Because if it doesn't, all you're doing is you're feeding water into a leaky bucket. Now, I want to be clear about something. I am not going to take credit for everything that I'm going to share with you today. A lot of what I'm going to be sharing with you is a lesson that Alex Hormozi taught me many years ago. And so all I'm going to be doing in this video is passing down what I have learned from him and then peppering in a few examples of things that might help you actually understand this a little better, and throwing in a few real examples of things that I've actually seen with clients over the last 3 years of working with them. Now, here's the thing. When he taught me this, when Alex Hormozi taught me this, I realized that 90% of businesses are not doing this correctly, and I, in fact, was one of those businesses that was not doing this correctly. So allow me to pass this on to you. Okay, so in business, there's really only two numbers that you have to think about when it comes to margin. So we have gross margin, and gross margin is, to put simply, this is the money that's left over after the cost of goods sold. Okay, so it's anything that it costs you to deliver a service, that's your gross margin. Next up, we have net margin. Now, this is very easy to understand as well. This is your gross margin minus all other expenses. So rent, taxes, software, everything else. Now, you might look at these two numbers here and think, damn, that sounds complicated. But gross margin is actually very easy to understand. And once you know this number, and I mean really know it, you'll never make a spending decision the same way ever again. So here's how it works. So what you do is you take your revenue, then you minus your cost of goods sold, and then that gives you your gross margin. So allow me to use a math example here to try and give you some clarity around what this actually means here. So assume that you sell something for $100 and it costs you $40 to actually deliver that service. That leaves you with $60, right? So 100 minus 40 is $60. Now, the way that we calculate gross margin is we just take our remaining amount and we just divide it by the amount of revenue that we generated. So that gives us 60%. Now, most of you sitting here see 60% and think to yourself, well, actually, that seems pretty good. That sounds great. Wrong. If you want to operate a highly profitable company, 60% gross margin is actually not going to get you to where you want to go. Unless, of course, you're fine operating where you're currently at and like to stay stuck and operate on razor-thin margins, then be my guest. However, I will not be joining you in that boat because I am here to make buku bucks. So that begs the question, if this is not good, what is? So what Alex Hormozi taught me is that 80% is, generally speaking, what we're going to be looking for when we're trying to scale a company. So companies that can sit at 80% or higher have a much higher probability of ever being able to achieve scale. Now, let me show you why this is so important. If you're operating a company at 60% margin and it takes you 40% is taken out from taxes, software and rent, and various other costs, right? In this example, let's just keep it simple. Then that means that you're operating at the end of the year on only 20% net. Now, what that means is out of your $100, you're only left with $20 to ever be able to scale the company, invest further into advertising, and actually let your balls hang, right? To be able to take bigger risks. And that's just never really going to be scalable for most companies. So you're stuck. You're profitable on paper and your accountant might be happy with you, but you're never going to be able to get there, right? You're never going to be able to actually scale up with margins like this. So let me prove to you why 80% is so much better. So if we take our margin from 60% to 80%, what we've done is we've increased our gross margin by 20%. But the actual trickle-down effect is that 20% also adds 20% to our net. So we can go ahead and add 20% to our net, giving us 40% net at the end of the year if we just add 20% net or gross margin. So effectively, what we've done is we have 2x'd the amount of money that we take home at the end of every year.
Which is fairly substantial, if you ask me.
And I want to be clear that the only thing that changed here, it's the same revenue in this example, right? It's the same revenue, it's the same business. The only thing that's changing is how much you're actually taking back. So the obvious next question is, well, that's great, Hunter, but how the hell do you expect me to take my gross margin from 60% to 80%? So let's talk about that. So it's very easy, right? There's only two ways that we can do this. So way number one, we can decrease the cost of goods sold. The way number two is we can increase revenue per client or sale, right? However you want to talk about it. Okay, so those are the only two ways that we can actually increase gross margin. Well, not the only two ways, but in this example, those are the two primary ways of doing that. So let's take a look at option one here. So in the math example we have above, 100 minus 40, it gives us 60% gross margin. So if we use the same revenue, right? So if we have $100 minus, and this time instead of doing 40, let's say that it only costs us $20 to actually deliver that service. Now we're left with $80 gross margin, right? So 80 over 100 is 80%, right? Which brings us to our 80% gross margin. Now, this is an option for some companies, but a lot of companies can't operate in that way. And generally, the reasoning behind that is as you start to decrease the cost to deliver a service, what can typically happen is that you either can't deliver it anymore because you've cut costs to the point where you actually can't deliver it because you don't have the manpower, the resources, or you still deliver, but it is such a poor quality that no one ever actually wants to continue to do business with you, right? Which brings us to number two, which is increasing the amount of revenue per sale or per client, however you want to talk about it. So in this example, let's say that we take our revenue and we sell it for $200. Okay, so now we're closing sales and we're bringing in $200 revenue per sale. And let's say that our cost of goods sold stays the same, so it's $40. Now what we're left with is $160, and 160 over 200 is 80% margin. And this is oftentimes a more sustainable model for companies because you can continue to deliver exceptional results and you're bringing in more revenue, right? So you're still sitting at your 80% margin, right? As we have there. So what this allows you to do is it allows you to handle more overhead and be able to take bigger bets when it comes to scaling, right? Because now your company is bringing in substantially more profit on the gross side, gross profit, to be able to reinvest into various other things in the company to help you scale. But I want to further drive home this point. So I really need you to pay close attention to this next part because this is where the real money is made. So after working with a little over 50 companies, our most profitable clients are the ones that have gross margins that are actually 90% plus. And so you might be thinking, well, but 10% more than 80%, I mean, that's not that much of a difference. And again, that's not how this works because as we increase gross margin, we substantially and exponentially increase the net revenue that we actually keep. So again, when we go from 80% gross margin to 90% gross margin, we've actually, again, doubled the amount of net profit that we take home at the end of every year. So let me go ahead and break this down again to make this very, very clear. Okay, so let's say that we again sell something for $200. Okay, and in this case, let's say that our company does actually have the ability to reduce our cost of goods sold to $20. What that gives us is $180 in gross margin, and 180 divided by 200 brings us to our 90% net or gross margin. And what that allows us to do is it allows us to take our 40% net that we had before, and now we are getting a 50% net margin, which means that you start to collect a larger war chest and take even bigger swings at scale and being able to actually grow your advertising budgets and be able to actually get to that point that you're trying to get to, wherever you're at now. Now, that's all fine and well, right? But here's what nobody tells you. Now, I want to share with you something that changes the conversation completely, because it's something that I learned how some of the biggest operators in the world actually operate their company. And the thing that they talk about isn't revenue, because the thing that matters is the amount of cash that you collect. So let's say that you sell a $10,000 package, okay? So you're selling a high ticket service for $10,000, but the client pays you over 6 months. So it takes you 6 months to collect this. So it takes you six months to collect $10,000. What that means is that every month you only have let's just round up, 1.7K in cash that you can leverage to scale your ads, pay your agency, and pay off the credit card bill, pay the AMX. So when you're running these calculations on a monthly basis, we need to be operating with the intention of looking at this number, so that way we don't start making bets that far exceed the amount of cash that we're actually collecting each month. Because in this example, if your margins look spectacular on paper, right, $10,000, and let's say it only costs you $2,000 to actually deliver that, well, great, we have 80% margins. However, if it costs you $2,000 to deliver this service and you're only collecting $1,700 in cash, you don't have as much cash to be able to actually take big swings. And so what's gonna happen is, as you start to scale up, you're gonna go broke waiting for that cash to actually be collected. So you need to factor this in when you're scaling up. And everything that we just talked about here, this is exactly why when we bring on a new client, on the sales call, before we ever even consider bringing them on, or even, they've even paid us to start running ads, the first thing that we do is we financial model out what this is actually going to look like for the client. Because when we are scaling, we need to be very conservative in the estimates that we have, so that way we don't get absolutely fucked when it comes to scaling up. Because when we get clarity around this, then we know exactly what our cost per lead needs to be, exactly how much our cost per booked call needs to be, what does our close rate need to be, what does our show rate need to be. Every aspect of the funnel becomes very clear, and we can set extremely accurate key performance indicators as we start to scale up, so that way we can see without a shadow of a doubt, is this going to be profitable if we hit the metrics that we know we should. So if you're somebody who has worked with agencies and felt like it just didn't work, oftentimes the reason that it feels like it didn't is because there was no clarity around this math. No one ever actually took the time to sit down and think, well, what is our gross margin? What is our payback period, right? How much cash are we actually collecting every single month? So that way we can actually double down and reinvest into ads without going broke. So if you've been staring at your margins at the end of every month and looking at the bank account and going, where the hell did all the money go? Now you know. It comes down to your margins. The fix isn't just more revenue. It's not getting more leads for cheaper. And it's not even looking for a new agency in most cases. It's just making sure that you get your gross margin right first, so that way every dollar you bring in actually builds the business instead of just covering costs. So if you're doing over $1 million per year in your company right now, and you're looking for an agency that can help you financial model out this, because just to be transparent, I withheld probably 80% of everything that I could talk about here and what we actually talk about with clients. But if you're looking for an agency who can help you scale up and make sure that you have the clarity that you need to be able to actually do that, click the link in the description to apply to work with us. That's all for now. See you in the next one.